In 2022, something unusual happened across the developed world. Central banks in the United States, Europe, and the United Kingdom began raising interest rates at the fastest pace in several decades. Within approximately 18 months, rates went from near zero to levels not seen since the early 2000s. The official explanation was straightforward: combat rising inflation. But if you look beneath the surface, there's a more complex story unfolding, one that involves significant shifts in wealth between savers and borrowers. And many people living through it don't fully realize the mechanisms at work. This isn't about conspiracy. It's about understanding how the system functions. The tools central banks use to manage economies create different outcomes for different groups. Understanding how these tools work reveals something important. Monetary policy, while aimed at broad economic goals, can have uneven distributional effects that often remain less visible until years later. Let me show you how this system operates. Who tends to benefit? Who tends to bear costs? And why the current moment represents a significant shift that will likely shape the next decade of economic life. The foundation: what central banks actually do. Before we can understand the distributional effects, we need to understand the mechanism. Central banks have several tools, but their primary lever is controlling short-term interest rates. When they raise rates, borrowing becomes more expensive throughout the economy. When they lower rates, borrowing becomes cheaper. This influences everything: mortgages, business loans, credit cards, government debt. But here's what often gets missed in the headlines. Interest rates don't just affect borrowers. They affect savers, too. When rates are low, savings accounts and safe bonds earn minimal returns. When rates are high, those same instruments can generate more meaningful income. For roughly 15 years, from around 2008 to 2022, interest rates across most of the developed world stayed near or at zero. In some countries, they briefly went negative. This wasn't an accident. It was deliberate policy. Central banks kept rates low to encourage spending and investment after the financial crisis. The logic was straightforward. If saving money earns minimal returns, households and businesses are more likely to spend or invest instead. That spending can stimulate economic activity. Businesses may expand. Employment can rise. The economy recovers. And it did work, to a degree. But economists widely recognize that every policy choice involves trade-offs. And the trade-offs here were significant. The 15-year experiment. Let's walk through what tended to happen during those years of near-zero rates. First, asset prices rose substantially. Stocks, real estate, bonds. Many investable assets became more valuable. Why? When interest rates are very low, investors often search for returns elsewhere. They buy stocks, they buy property, they buy corporate bonds. Increased demand for these assets tends to drive prices up. If you owned assets during this period, your wealth likely grew. The S&P 500 roughly tripled between 2009 and 2021. Home prices in many major cities doubled or more. Wealth accumulated for those who held investments, but if you were primarily a saver, someone keeping money in bank accounts or conservative bond funds, you earned very little. In real terms, after accounting for inflation, many savers experienced stagnant or declining purchasing power. This created a divergence. People who owned assets generally saw their wealth grow. People who relied primarily on savings often saw their wealth stagnate. The gap widened, not necessarily because of individual choices alone, but partly because of how monetary conditions affected different asset classes. Second, governments and corporations borrowed more heavily. When borrowing costs are low, debt becomes more attractive. U.S. federal debt grew from roughly $10 trillion in 2008 to over $30 trillion by 2023. Corporate debt also reached elevated levels. This wasn't necessarily reckless. It was often a rational response to the interest rate environment. But here's the mechanism that's less visible to most people. When you borrow money at a low nominal rate and inflation rises, the real burden of that debt can decrease over time. If you borrow at 2% interest and inflation runs at 4%, the real cost of servicing that debt becomes negative. The debt becomes cheaper in real terms. This represents an indirect transfer of value. Borrowers can benefit from inflation eroding debt burdens. Savers holding cash or low-yielding bonds lose purchasing power. And this happens gradually, through the erosion of real returns rather than through any explicit policy action. The reversal. What happens when rates rise? Now let's move to 2022. Inflation surged to levels not seen in roughly 40 years. Central banks responded by raising rates significantly. The Federal Reserve went from 0.25% to over 5% in less than 2 years. The European Central Bank and Bank of England followed similar paths. This reversal created a different set of outcomes. For savers, returns on safe assets improved substantially. A high-yield savings account that paid around 0.1% in 2021 was paying 4% or more by 2023. Retirees and others living on fixed income saw their interest earnings increase. This represented the first meaningful return on safe savings in over a decade. But for borrowers, the situation shifted. Mortgage rates roughly doubled in many markets. Business loans became more expensive. Credit card debt, which often carries variable rates, became significantly more costly to service. And here's where it gets interesting. Those who borrowed heavily during the low-rate era now face higher costs on new borrowing or variable-rate debt. While fixed-rate borrowers remain locked into their lower rates, the overall cost of credit in the economy has risen substantially. Meanwhile, asset prices began to adjust. Stock markets became more volatile. Real estate markets cooled in many areas. The wealth effect that supported growth for over a decade started to moderate or reverse in some cases. This illustrates how monetary policy affects different groups differently. The timing of when you're a borrower versus a saver and what assets you hold significantly influences how policy changes affect your financial position. The hidden redistribution. Let's make this concrete with a hypothetical example. Imagine two people in 2010. Person A owns a home and has investments in the stock market. Person B rents and keeps savings primarily in bank accounts. Over the next 12 years, Person A's home value might have doubled in many markets. Their stock portfolio could have tripled or more. They didn't necessarily do anything extraordinary. They held assets during a period of monetary expansion and low rates. Person B's savings account earned less than 1% annually in most cases. After inflation, they likely lost purchasing power in real terms over that period. By 2022, their savings bought less than they did in 2010. Now rates rise. Person A faces higher borrowing costs for new loans or mortgages. But they've already accumulated significant wealth through asset appreciation. They're generally better positioned to weather the change. Person B finally starts earning positive real returns on savings, but they're starting from a diminished base in real terms. The wealth gap that opened over the previous decade doesn't automatically close. It tends to persist. Economists sometimes describe this as an indirect distributional effect of monetary policy. It's not a tax in the traditional sense. No government agency collects it directly, but the effect can be similar. Real wealth shifts from those holding cash to those holding appreciating assets, mediated through inflation and interest rate policy. And here's what makes it particularly noteworthy. This redistribution can happen regardless of income level. A middle-class family that bought a home in 2010 likely benefited from appreciation. A high-income professional who kept substantial cash in savings may have lost ground in real terms. The determining factor wasn't only how much you earned, but what you owned and when. Why this matters now. We're at what appears to be an inflection point. For the first time in roughly 15 years, the monetary environment has changed substantially. Rates are higher. Inflation has moderated from its peak, but remains above historical averages in many economies. The conditions that prevailed from 2008 to 2022 no longer apply. This creates uncertainty. Asset prices that rose steadily for over a decade now face different conditions. Borrowing costs that were negligible are now material. The strategies that built wealth in the previous era may not work the same way going forward, but it also creates different opportunities. For savers, this represents the first sustained period of positive real returns in years. For younger people who couldn't afford to buy assets during the boom, cooler markets may offer more accessible entry points. The key is understanding the mechanism. Monetary policy will likely continue to create different outcomes for different groups. The question is whether you recognize how these conditions affect your particular situation. The broader implications. There's a larger point here that goes beyond individual financial decisions. When monetary conditions create significant distributional effects, research suggests it can affect social cohesion. People who feel the economic system produces unfair outcomes may lose faith in institutions. Political polarization can increase. Populist movements may gain traction. This isn't abstract. Many economists and political scientists have observed these patterns across the developed world over the past decade. Rising wealth inequality, much of it associated with asset price inflation, has coincided with political upheaval, Brexit, the rise of populist parties in Europe, increased political polarization in the United States. These movements have economic dimensions that many researchers have documented. Central banks don't operate in a vacuum. Their decisions ripple through society in ways that can extend beyond their primary mandates of price stability and employment. And here's the challenge. Central banks are tasked with managing broad economic conditions, but they're not primarily designed to address distributional outcomes. That's typically the domain of fiscal policy. Taxes, spending, social programs. But when fiscal policy is constrained or politically gridlocked, monetary policy often becomes the most active tool available. This can create a mismatch. The tool being used isn't optimized for all the problems it's being asked to address, and unintended consequences can accumulate over time. The story of the past 15 years is largely the story of monetary policy as a dominant force shaping economic conditions. Low rates, asset price appreciation, shifts in wealth distribution. These weren't merely side effects. They were, in many ways, predictable outcomes of the policy environment itself. Now, as rates have risen and the environment has shifted, we're entering what appears to be a new chapter. The conditions that governed the previous era no longer apply. What worked before may not work the same way now. Understanding this doesn't require predicting the future with certainty. It requires recognizing the structure and mechanisms at work. Monetary policy can have significant distributional effects. It has historically. The question is whether you see these patterns as they unfold. For many people, these mechanisms remain less visible. They experience the effects: higher costs, stagnant real savings, rising asset prices, but may not connect them to the underlying monetary conditions. But once you understand the mechanism, it becomes easier to see. And that awareness can change how you navigate the system. This isn't about gaming the system or finding loopholes. It's about understanding the forces at work so you can make more informed decisions. Whether you're a saver, a borrower, an investor, or all three, the monetary environment shapes your financial reality in significant ways. The distributional effects of monetary policy are real. They've been operating for over a decade, and they're likely to continue, though perhaps in different forms. The question is whether you recognize them and understand how they might affect your situation.